We did have a nice rally at the open. It's all but disappeared. Crude is now moving up. It was lower. The market liked it. Now crude is higher, moving back towards 97 a barrel. Weiss, I mean, this seems pretty obvious at this point. Stocks are going to have a hard time finding the footing that I suggest they're looking for, as long as the Strait of Hormuz remains effectively closed. Despite efforts by members of the administration to ease concerns about that, there are plenty of concerns. And that's why the market looks the way that it does.
Yeah, and that's something you can't spin. If the administration is saying, look, we'll have the Navy escort, it's fine and all this, it's going to open soon. You can't spin it because there are too many pictures of the ships lining up and too many announcements of nothing getting through. And that's what's driving the market at this point, as you point out. Because if you keep oil prices elevated for so long, you have the chance, and you hear the R word more and more, meaning recession, of coming through. So my position has been, look, I'm keeping my cash. I don't want to catch a falling knife. I don't know how far it's going to fall. I did, in your absence, put on one trade, FTAI, which I thought had come down enough, and I'm going to close that trade out probably later today or tomorrow. It's been a major loser. So this is not a trading market, and my regret is that it's prone to doing stupid things. You see something and said, wow, how can that go down another 25%? And guess what? It's on its way down. So to me, it's just keep your hands in your pockets. You have different strategies if you're long-term or if you're intermediate term, short-term. If you're long-term, look, frankly, any place you buy, if you buy the right stocks, they'll be higher in a reasonable time frame. But if you're a trader or you're focused shorter intermediate, then it's not so easy to determine.
I'll just give people one more look. You throw WTI up intraday and then put the S&P intraday back up, because it really tells the whole story. I know that we keep mentioning that, but how can you not? Just given the way that the market continues to trade. I thought it would be wise, I think, 2 weeks almost into this conflict, to take a look at what the major averages have done. S&P's down about 5% now. So you're not in a pure 10% correction, but, the negative news flow has many on Wall Street thinking that the risks are still decidedly to the downside. Goldman's Tony Pasquarello says if there's asymmetry to the S&P, it's more likely towards the downside outcomes than upside. And that suggests local risk reward is not in favor of the bulls. How would you assess that, Bryn? It's pretty obvious what you need to keep watching to decide whether this market's going to find a little bit of footing, as we suggest.
Yeah, and I think, Tony also so appropriately said time is the enemy around energy prices and the war. So I think all you need to do is look at what energy prices are doing to see what the market's going to do. I think we also have the 200-day moving average for the S&P is 6,600. So we're only about 47 points away from that. I think people will continue to be skittish going into weekends, the longer this lasts. I do think, once again, this crisis is not like Venezuela. The mullahs have been in power for 4 decades. I don't think they're going to leave easily. And so I think that does rightfully have investors nervous that we don't want a long, drawn-out war. And so I do think this is going to continue to dominate not only the headlines, Scott, but just the markets. And so 6,600 seems very plausible. That is somewhat gravity for the market. And so I think investors should be prepared if we have some more turmoil. That 6,600 is really the next strong support for the S&P. And I do think, I'm talking my book and Kevin's book, this is a great time to be selling calls. And so I think that's where the premium's high on a lot of names. So you can sit still in your names and sell calls. And that's been a good strategy all year long. And so we'll continue to do that and collect that premium while we have this really elevated volatility.
Jimmy, what's your view?
Well, I'm sorry to make it as simple as what we've already said, but it comes down to the Straits of Hormuz. It really is that simple, and nobody knows, certainly not me, when they will open. But I do believe that when you get that announcement, however it comes, maybe it's actual ships flowing, maybe it's, we know we really can't rely on the word from the administration. I'm sorry to say that, but we've had too many false starts in that regard. When the market feels that the Straits of Hormuz are open, it is likely that the markets will go much higher. Now, one asterisk to that. We can't have the Straits Straits of Hormuz closed for a long time, and then expect everything will be rosy when they reopen. So as I said yesterday, Scott, it really is in the month of March that we have to resolve this. After that, there is lasting damage. Now, what does lasting damage look like? Well, we're going to be in the pre-announcement season next week, and if you start to see pre-announcements from companies, that will worry us. If you start to think that maybe the earnings might be affected for more than just the first and second quarter, that's the sort of lasting damage that we need to look out for. Again, I think if you get this resolved by the end of March, we should be okay, but a lot of uncertainty here. The market's responding as it should be.
At least 2 more weeks, at least if your timeline plays out of volatility, if nothing else.
Yep.
Kev, so Michael Hartnett of Bank of America today, with a headline on his note, Wall Street ominously trading 07-08 analog. Asset performance in 26 is more ominously close to price action seen from mid-07 to mid-08. Oil peaked July 3rd of 08, the same day as the ECB hiked, one of the great policy mistakes of all time. 74 days later, Lehman bust, global financial crisis in full effect as credit trumped oil. Then he finishes with this ominous sort of trading pattern, the analog back to 07-08. I don't know if you want to take a stab at that in the context of how you view what we're witnessing within the markets today.
Well, fortunately, I don't, because I read the note, and I think that there's similarities that we can find in any disruption. So when you have a geopolitical event like we're seeing in the Middle East, it's easy to make these comparisons. I don't think the backdrop is the same, but I think Jimmy's point is the most important, which is if we can resolve this more quickly, that's going to be a much more appropriate runway for the stock market to recover.
Now, does that seem like it's going to, like, what are, you guys play probabilities, right? I mean, that's what this whole game's about. It's the probabilities, not the ifs. So there are a lot of ifs. Like if you're saying, well, if this can get resolved quickly, does it seem like it's going to be?
So it's so easy to play political science expert. I'm not. I'm a stock person. So I can look at it and say, I hope that it gets resolved. I don't know. But to the point of earnings, we're looking at double-digit earnings expectation for 2026. If this oil price stays higher, it affects not just the consumer, but margins, corporations, and ultimately earnings, which is why you said 1 to 2 quarters of guidance. If this gets resolved over the next 2 weeks, I think we can put it in the rearview mirror. If it doesn't, I think we'll need to worry about it. I don't know what the odds are.
You know, it's not only about probability, definitely about probability, but it's also what's the risk? Do I have greater risk to the downside, or do I have greater risk to the upside, depending upon which I determine? So your probability weight that.
Gosh, I don't know how you can answer that with any pure level of conviction.
And that's the point. And that's exactly the point.
Because a headline about Hormuz or a movement in oil, that's positive. You're probably going to have a rally rip like you haven't seen.
Which is why you can't be short. Yeah, which is why you can't be short.
Which is why the battle right now is between getting more bearish and what some have called the so-called Trump put. Citi today says investor positioning is becoming more bearish, converging towards levels seen during previous conflicts. However, the de-risking is not yet at extreme levels, suggesting a measured response rather than widespread risk-off positioning. Barclays says investors still believe in the Trump put. Hence, global equities are not down as much as in past oil shocks. Obviously, nervousness is growing by the day, and the longer the strait stays closed, the more stagflationary markets will turn. But that's the battle, Bryn, right? The battle between growing more bearish and the so-called Trump put, among other things.
Well, we may agree with the Trump put, but do the Iranians. So, I mean, ultimately, China has to step in, what have you. So this is, to me, like the Trump put, I think, is there. We're in the midterms. It already looks like the Republicans are going to lose a lot of seats. We have inflation going higher. And so if you just think about it from a put perspective, we can't have a prolonged war for a bunch of different reasons. But the most important one is just like the U.S. economy does not have the tolerance for that. We need to have oil prices come down and not get embedded in the economy. And so I think the Trump put is there, but I do like to balance myself. Do the Iranians care about that? And to me, when it's like existential, their survival from a leadership perspective, I think that adds just like a wrinkle that's very hard to map out how this actually ends and what does that end actually look like.
That's true, right?
Yeah.
Although, I mean, let's be honest. What is a perhaps fair amount of resistance today by the Iranians may not be tomorrow. We'll have to see how this all plays out. Amid other reports that we've got more apparatus, both human and technological and physical, heading to that region.
Yeah, and if you do put boots on the ground, that extends the conflict, that extends the worry in the market, that extends the concerns of forever war, which I don't think is ever going to be on the table forever war. But, you've got the backdrop then going to Michael Hartnett's note, which I disagree with. This is nothing like 07, 08. But there is an issue, there are headline risks. And by that I mean that why it's not 07, 08, because the banks are much better now, much better risk managers. They don't have those issues.
I think he's just looking at some of the trading patterns. Right. I don't think he's saying that this is another 08. Yeah. He's just looking at the way that, oil had moved, how central banks had reacted. We do have meetings next week from not only ours, but European, the ECB. So he's just looking at the way that certain things have traded and different fallouts that have happened. He is not, I don't believe, suggesting we are in another pre-08 crisis position of that magnitude.
Right, but a lot of people read it and they see 07, 08, and that's their biggest fear. But what I'd say is that the headline risk is not just with the strait. The headline risk is when all these funds stop allowing redemptions. Now, you fund redemption. What these let's just do trading 101 here. You invest in a private credit fund, they then allocate that to loans. So theoretically, all their capital should be in loans, which are illiquid instruments. So when a redemption comes, they borrow money from a bank. Hedge funds, that's what we do. If somebody wants to take some money out, we're in positions. We're not selling, we're buying, we're borrowing until we're ready to sell. So the banks are not giving out that credit. So the headline risk is BlackRock. I'm not saying they'll do it, they won't do it, very well capitalized. But a big name, a brand name like that says no more redemption private credit, then that's when things get really, really ugly.
Well, there is a view as well that the actual fundamentals of private credit are perhaps better than meets the eye, better than what the overall narrative may suggest. They're not. Well, of course, with some exceptions. Yeah. No doubt, but there are always some.
No, but I mean, but there are so many private credit funds out there that it's just lunacy. When I say some, I'm comfortable with the big ones. I'm comfortable with the big firms because they have very, very mature risk management. But you've got so many. How many emails do we all get? Let me fund your business, today. So lots have done that. It's ubiquitous. That's the danger.